we're talking about simple IRAs. So I'm going to go over what those are and if one might be useful to you and how you might use it.
It's the greatest name for a retirement plan ever, right, Zach? Simple IRA.
It makes me want to use it.
Just the name makes me want one.
You know, we have 5 values that we try to do everything with here at Wise Counsel. The acronym, many of you on the call have heard us mention it. It's SURE. And the S, the first letter, stands for simplicity. So, you know, I don't think that they had Wise Counsel in mind when they had this, but we certainly seems to fit what we do pretty well.
Let's get rolling. Let's talk about this.
All right. So thanks for joining us again. And if you're just now popping in, we're going to be talking a little bit about simple IRAs. It's going to be a pretty quick call today, and just want to go over what that is. You may already have a simple IRA and are not sure what exactly it is, but maybe you've been adding to it. You started a position at a job somewhere, or maybe you're a small business owner and you're wondering, hey, you know, I know I've got some options out there, SEP, solo 401k, simple. Well, we're going to be spending some time talking about the simple and how you might be able to use some of the benefits it offers. So I don't actually know, Bob, maybe you know when simple IRAs entered onto the scene and became an option. I think, you know, I know as long as I've been doing this, they've been around, but.
You know, I don't remember the year, but I want to say it was in the 90s, maybe sometime in the 90s when they first rolled these out. The idea was to try to make it easier for small employers to do retirement plans for themselves, but also their employees if they had, well, as you're going to talk about a little bit later, I think you got to have less than 100 employees to be eligible. But most people who use these tend to have maybe 10 employees or less. And it's a lot easier. The theory was it was a lot easier than, at the time, a way more complicated 401k type plan, that kind of thing.
Yeah. Yeah, you're right. Fortunately, with electronic forms and things, opening any account type seems to have gotten a lot easier these days. But the simple IRA, I think, really tried to emphasize the ease of it. So if you're a small business owner, maybe you're self-employed, that I would say is probably 90% of the simple IRAs we're helping people with is for individuals who are self-employed and they're essentially the only person in their business. So that's really the easiest situation. What it is a simple IRA is a retirement plan option that you have that you can contribute to if you're working and have earned income. So it kind of serves the same purpose like a 401k or any IRA. If you're not working, then you can't really utilize that. But like other account types, it has different income limitations and amount that you can put in, or contributions limitations really. But simple IRA is actually an acronym, and it stands for Simplified Incentive Match Plan for Employees. And then of course, IRA is individual retirement account. So it is an option. Again, if you're self-employed, it's really easy to set these up. And it's really easy to maintain. There's not a cost. It's pretty much the same amount of work for a self-employed individual without any employees as it would be to set up almost any other account. And as a simple IRA, the simple IRA plan allows for contributions to be put into it, money to be put in it, both from the employee, but then from the employer as well. So there's and of course, if you're self-employed, then you're your employer and you're the employee. So you can actually add money for both of those roles. So you can actually even contribute a little bit more than someone that's just a participant as an employee.
Zach, something that might be helpful is for us to talk about an example and maybe start off with what we see a lot of times is just somebody who is let's say they do consulting work after their first retirement or something like that. Mm-hmm. And maybe they're making $20,000 a year in consulting income, and they don't really need it because they've already got other sources of income. And they're wanting to know, well, could I still add to an IRA? What are my options? And then we might bring this up as one of the most appropriate options for them. So let's explain how the simple plan would work for that person. And then once we kind of get through that, let's talk about, well, what if it was that same person, but they had maybe 2 employees? Maybe that'll help make this easier to understand for folks.
Yeah, and that's a good example. We have several situations we've seen over the years where somebody is working after their first retirement, and they have earned income. They want to know where they can put it and where they can get a tax deduction for it, right? They want to save in the best, most beneficial tax manner. The simple IRA, again, there's a few options out there, but one of the unique things about it is you can, if you're earning, in this case, $20,000, you could put in up to the maximum. So a simple IRA for an employee, you can do up to $13,500 a year. And that's for 2020. That amount goes up a little bit every year for inflation. But as an employee, you can do $13,500. That's if you're under 50. If you are over 50, the IRS says, hey, you're a little older, you don't have as much time left to save. We're going to let you do $3,000 on top of that. So if you're over age 50, you can do $16,500 per year. And now in the case of a consultant, someone who's self-employed, there is a match portion. So normally the IRS gives all employers who have a simple plan 2 options. They say you can do a 3% match of someone's salary, or as long as they're contributing, right? Same way that typically we see on 401ks, right? If you add money into a 401k, a lot of times, sometimes the employer will match up to 3% of your salary. Same thing for a simple, or in some cases, the employer has the option, you can just do a flat 2% of the employee's salary, whether the employee contributes to add $1 or not. So, you may say, oh, well, if I do the flat 2%, that's a little lower if everybody's participating. But for a self-employed person, you say, hey, well, I don't get a salary. Well, for the self-employed person that's earning $20,000, basically they would just calculate what their profit is, or their net earnings from the business. So maybe they have $5,000 in expenses and they earn 30,000, then their profit would be 25. And so it would be 3% of that what they could contribute for the employer portion. And that employer portion would be in addition to the 13,500 or the 16,500 if you're over 50.
Yeah, and that's where this can be so powerful for people in that position. If they don't need the money, I mean, if I kept up with you on the math there, let's say they are over 50. If they're retired, they're certainly already over 50 for the most part. Mm-hmm. So they could put 16.5 in plus $750. That would be the 3% in your example of the 25,000. So what is that? $17,250. Mm-hmm. Almost the entire amount, or 70 or 80% of what they're making they're getting a deduction for it. It's going into this simple plan and they're investing it. And it'll be subject later on when they get to be 72 to the normal required distributions like IRAs are. But for now, they're sheltering all of that self-employed income from taxes.
Yeah. Yeah. And it's a great option in that case, 17,500 on 25,000 income, you're contributing, almost 3/4 of what you're making. It's tax deductible.
Let me interject something here too, Zach, because the thing that I've seen the most commonly to be the case when people come in, a lot of times if they were already doing this self-employed role, a lot of times they've already opened up a different kind of plan before that. They opened up an SEP, a Simplified Employee Pension Plan, and that's fine. But why don't you explain if they wanted to put in more, why? For somebody earning in that range you were just talking about, why is the simple plan better than the SEP plan?
Yeah, the simple plan is particularly advantageous when someone has a lower amount of earned income or when your income's lower from your business. And the reason is that with an SEP account, you can only do about 20% of what you earn. So going back to that 25,000 amount that we were talking about earlier, the max amount that person could put in an SEP would be about 20% of that. So about $5,000. So there's that limitation, that 20% limitation of what you're making. With a simple plan, you can do up to 100% of what you make. And so you may be an author, let's say, and you had a children's book. Maybe you made 12 grand from that selling that book one year. With the SEP, you'd only be able to do about $2,400 into save and get a tax deduction. With a simple, on the other hand, you can do a full 100%, $12,000. So you can do 100% of what you're making, just as long up to that 13,500 amount or that 16,500 amount. And so it's not, if somebody really wanted to max out an account, the SEP or the simple is the better option until you earn up about $80,000 in a year. Yeah. Over 80,000, then the numbers are going to calculate so that you could contribute a little bit more to the SEP account than the simple. Another thing that people run into a lot of times, Bob, with the reason that they have SEPs honestly is because, people start businesses, they don't know whether you're going to make money or not, but you're doing your taxes, right, for the previous year. And you're saying, hey, I can save some of this money. Well, accountants will often recommend SEPs because you can open an SEP after the calendar year is done and add to it for the previous year while you're doing your taxes. That's one of the big things about a simple plan, and it's kind of relevant right now, because if you want to open a simple plan and you want to contribute for the current calendar year, you have until October 1st to open the plan. That's the deadline. So if you're watching this video and you're saying, hey, I want to put money in for this year and it's November 15th, you're going to have to wait until January 1st to open one next year, because that October 1st deadline's already passed. So there is a limitation to contribute, and if it's October 1st and it's passed. So maybe you could do an SEP if it's past October 1st for the current year, and then next year you open a simple because you'll be able to do more. You can actually move the money from the SEP into the simple. So that may be an option that works for you. So we talked about some of the limitations there, Bob, on the income side of things. So you can see how this can really be a good option for self-employed people that are, have under that $80,000 in income. Wanted to briefly touch on if you have a small business. So obviously, if you have employees and you're withholding amounts from their payroll and you're adding it, that's going to be a little bit more involved, not as streamlined of a process, but simple plans can be used for small businesses. Bob, you mentioned earlier, the IRS says in order to be a small business, you have to have under 100 employees. So that would be one of the requirements. Sometimes you may have 10 employees and you come to us and you say, hey, I'm ready to start putting away and saving for myself. But if you do open a simple plan for yourself to use, it has to be available to 100% of the employees. So that is a question that we see often is, does this, I have to add that 3% match to, all 10 of my employees, and that would be the case. So the IRS is pretty strict about those rules. There's some requirements that can be put in place, like you have to work for the company for 6 months or I think up to a year. But if you do have employees and you're considering opening one of these, I definitely see that as something that you have to offer to everyone who is an employee of your business.
Yeah, I mean, it's possible to exclude part-time employees. You've got some options there but if they're full-time, they have to be given the opportunity to enroll. Now, and that circles back to your matching thing. The 3% match is great for the participants who choose to put money in, But if they don't choose to participate and put any money in, they don't get the match at all. But if you went with the 2% match as an employer, then you have to put 2% into every eligible employee's account, even if they don't contribute themselves. Most of the time people choose the 3%. Number one, it allows them to put more of the match in for their own account, but also as the owner, but also, they're being more generous with the people who are saving out of their own pocket. And so they'll match that 3%. To the extent that the employee puts in at least 3%, then that'll be essentially doubled.
Right. Yeah. Right. Yeah. So there is, if you're considering doing that and you have employees, one of the other things to know is, if you're taking the money out of their paycheck, if that employee chooses to add, that money has to be into their employee account by basically whenever month they are receiving that paycheck. The money would have to be contributed into the simple 30 days after the end of that month. So basically, if we're in the middle of the month, you have until almost the end of the next month. So there is a time. They don't want employers to, withhold money from paychecks and then just, keep them in a bucket. So that is a part of it. And it's actually relevant too if you're self-employed, because technically it's recommended that if you do have one of these accounts, that you put in your employee portion, even for a self-employed person, by the end of January, just to meet that 30-day rule. So I've seen many times whenever that money's added later, and obviously there's not if you're self-employed and you're in control of everything, then you're the employer and the employer, then that's not such an issue there in terms of kind of acting as a fiduciary for your employees. But that is a piece of it. So I hope that's been helpful for you guys that are considering a simple, and maybe whether an SEP or again a solo 401k would be an option for you. But options from years to years may change. You may start out with your business, you have a lower income, and a simple's the best choice to begin with. And then in some of the next year, you start earning more, and maybe a solo 401k or something's good. But do give us a ring if we can help sort through the options for you. Bob, did you have any final thoughts before we finish up?
Well, I'll just say the great discussion. It's a simple idea, but it's amazing how often it's not picked up on. And I think it's a great example of how people who do what we do in our office, Zach, we tend to, or we're looking more down the road. And most accountants are so busy doing returns that they're usually working to the deadline, of the tax filing deadline, and they're hammered by all of these returns they got to get done. And so you made the great point about the SEP. Sometimes it gets done because by that time that's their only option. It's why it's really good to have a team of people working with you, because we like to look for things that are future oriented. Are there ways that we can, ideas you can take advantage of where there's still plenty of time to do them, whereas the accountant oftentimes is dealing with what's already happened and just getting the return done. When you've got both of those sides covered well, it's really your best scenario. And, speaking of taxes, I'll give a plug for next week's discussion. I'm going to be going through, we might have a local CPA on, where we haven't confirmed yet, but we're going to be talking about how is non-IRA income taxed. And so we're going to be talking about interest income, dividend income, capital gains, that kind of thing. It seems like a pretty simple idea, but when you start digging into it, it's a lot of people don't understand the difference in those kinds of taxes. And so we're gonna break that down next week.
Awesome.
That's all I got.
Well, hope you guys can join us next week for that discussion. Thanks for joining us today, and we'll talk to you soon. Enjoy the rest of your day and have a good week.
Have a great, yeah. Thanks, Zach. See you guys. We'll see you next week. Bye-bye.